For the first time this year, the United States Federal Reserve has cut interest rates, a move that underscores growing unease about the nation's economic direction. While lower borrowing costs are usually celebrated by markets and consumers, Fed Chair Jerome Powell today struck a more sobering tone, warning that the risks to American employment are mounting. The announcement comes after months of mixed signals in the US economy. Inflation, once the primary concern of policymakers, has cooled from the highs of recent years. But as the battle against rising prices appeared to be won, another threat has emerged, a slowdown in job creation. Powell emphasized that the labor market, long described as resilient, is showing unmistakable signs of fatigue. Let us listen to the Federal Reserve Chair himself. Insert soundbite. Jerome Powell, US Fed Chair, 41 seconds. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. Powell's words capture the dilemma facing the world's most influential central bank. For nearly 2 years, the Fed's mission was clear: bring down inflation at any cost. Aggressive rate hikes cooled consumer demand, slowed housing markets, and raised the cost of borrowing for businesses. But as inflation gradually returned toward the 2% target, the cost of this victory is becoming visible. Employers are pulling back on hiring, participation in the labor force is shrinking, and wages, though still rising, are losing momentum. The situation is unusual. Historically, a strong labor market provided the backbone of American economic confidence. Now, Powell warns that both the demand for workers and the supply of workers are weakening at the same time. Lower immigration has reduced the number of new entrants into the job market, while participation has declined among key age groups. Combined, these forces are reshaping the economy in ways not seen in decades. The decision to cut rates, therefore, is not only about stimulating growth, it is about preventing a deeper erosion of employment, the one factor most directly tied to the well-being of ordinary Americans. But the timing of the move is politically charged. President Donald Trump has been unrelenting in his criticism of the Federal Reserve, accusing it of keeping rates too high for too long and slowing down the American economy ahead of a crucial election year. By lowering rates now, the Fed is likely to face accusations of bowing to political pressure. Powell, however, framed the decision not as a concession, but as a necessary adjustment to safeguard jobs. The stakes are high. Cheaper borrowing costs could help businesses invest and hire. Families may find mortgages, car loans, and credit card rates slightly more affordable, but economists caution that this relief may not be enough to reverse the underlying trends dragging the labor market down. For many workers, the outlook is uncertain. The pace of job creation has slipped below what economists call the break-even level, the minimum required to keep unemployment steady. If this trend continues, the unemployment rate could begin to rise in the coming months. That would mark a sharp reversal from the past decade, where historically low unemployment was a point of pride for both policymakers and politicians. Meanwhile, wages, once a rare bright spot for American households, are losing their edge. While paychecks still outpace inflation, the margin has narrowed. Slower wage growth threatens consumer spending, which accounts for 2/3 of the US economy. If Americans cut back on shopping, traveling, or dining out, businesses may face another round of contraction. Internationally, the Fed's move will ripple through global markets. Lower US interest rates tend to weaken the dollar, alter capital flows, and influence central banks from Frankfurt to Tokyo. For emerging markets, the consequences could be especially significant, as shifts in US monetary policy often trigger volatility in currencies, debt markets, and trade flows. But back home, Powell's warning about employment may overshadow all other debates. It was just months ago that analysts described the American economy as remarkably resilient, defying predictions of a recession. Today, resilience has given way to fragility. The Fed's task is no longer just to tame inflation, it is to keep America working. Critics argue that today's move comes too late. They contend that the Fed should have pivoted earlier. before job growth began slipping below sustainable levels. Supporters, on the other hand, insist that Powell is steering the economy away from a potentially deeper downturn, making the tough choices when they are needed most. One thing is clear: the balance of risks has shifted. Inflation may still matter, but the threat of rising unemployment looms larger than it has in years. In Powell's words, the downside risks to employment have grown. For the millions of Americans whose livelihoods depend on steady work, today's rate cut is more than a technical adjustment. It is a signal, a warning that the Fed sees danger ahead. Whether this policy shift can avert that danger remains to be seen. As the central bank walks this tightrope, the political, economic and social consequences will be profound. In the coming months, the Fed will be tested again and again by markets, by the White House, and by the American people themselves. For now, the message is sobering. The US economy is cooling, jobs are at risk, and the Federal Reserve has begun to act. But the question remains, is this the start of stabilization or the beginning of a more turbulent chapter in America's economic story?
A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen.